circle.
I see that.
Good. All right. Can you hear me okay?
I can, yes.
All right. Awesome. Well, we're live. Here we are. So my name is Drew Whitson. I'm one of the mentors here with the Michael Blanc Education Program. And I am very excited about having a new series that we're going to be putting through for the Dealmaker Mastermind. It's called Invest Like a Boss. And so for the next 4 weeks, we're going to be doing these live interviews with different members of the Nighthawk Equity team. We're going to be focusing on basically the entire transaction process, starting with acquisitions, how you understand and market and underwrite a deal, all the way through closing, through post-purchase, and how you manage your investors, and even on the back end of how you be a great asset manager. So anyway, very excited here. There's a lot of great content here that we're excited to really get out and really just highlight some of the people behind the scenes that have been so successful and can give you the best tips and tricks. So we can get crack into this. So I'm with Garrett Lynch, who's the Acquisitions Director for Nighthawk. How you doing, Garrett?
Great.
Awesome. Well, let's just dive right into this. Garrett, tell us a little bit about your background in real estate and kind of what your responsibilities are with Nighthawk.
Yeah, so this is actually my second partnership. I started my first company when I was, I think it was 26 in 2013. But I've been in real estate for probably about 10 years. Started out just like wholesaling deals, and then I got in basically into more of the multifamily side with my business partner at the time. We went to work for a guy that for about 6 months that was doing 1,000 units, or he had like 1,000 units. And so we kind of learned the game from the inside, and we're like, hey, we have the resources to do this ourselves. Let's give this a shot. And so we started the company and just didn't really know a ton about what we were doing. And we ended up we found a good equity source. We ended up acquiring about 3,400 apartments in 3 years. So we just went on a buying spree. And at that time, there were a lot of deals to be had, and it was exciting. So we just vertically integrated that entire company. So I built a management company from basically the ground up and ran them all internally. And then I had an exit at the end of 2016. So I exited that company, and then I went on a little bit of a hiatus for a couple of years, just traveled the world, did some stuff, and then found Michael and Drew in like 2018 and linked up with them. And then we've been working together for the last probably like year and a half, I'd say. We just closed 2 deals last year, one in August, Little Rock, and then another one in December at Huntsville, and looking to grow the business even further. So yeah, that's a little bit about me.
Fantastic. So you got hooked up, and just to be clear, you're talking about Drew Niffin with Michael Blanc, not Drew.
Yeah, Drew Niffin.
Drew's around here. Yep. Okay, so you got started with them, and they asked you to come on board. And what does your day look like day to day as the Director of Acquisitions for Nighthawk?
Yeah, so day to day, it's a combination right now of I'm constantly spending, I'd say probably 60% of my time right now is spent just reaching out to brokers, chatting with them, building those relationships out, and writing offers, underwriting deals. You have to have a bit of an understanding of all the facets of finding and acquiring deals in a way. For the most part, I'd say, what's most important is that you understand kind of the underwriting, the math behind the deals when you're looking for them. So it just makes things go faster. There are some people I know that, they have like an underwriter that they work with or whatever. That's fine, but there's strategy behind it. So the better you can get at, using the SDA and just really understanding how the business works in alignment with the numbers, I think the better. And it's a lot of deals right now. I have a ton of off-market deals that are hitting my plate that I have to underwrite, do a quick underwriting on, see if it matches up, if I want to move forward into that one, and then if not, dish it to the side and go after the next one. So, this is always the case in this time, but right now it's even more the case where I have a lot of deals that just aren't working. So it's a numbers game. It's all about volume right now. It's just finding as many as possible, underwriting it that fit within your parameters. If it works, put an offer in. If it doesn't work, dish it to the side and go after the next one.
Tell me about how broad that deal funnel looks like. How many deals are you aware of versus deals you underwrite versus deals you wrote LOIs on versus deals you close? Tell me what that funnel looks like and what you recommend in terms of, for people that are curious about how much volume they need to do to land that good deal.
Yeah, I'm looking at deals every week, probably anywhere from, depending on the week, like 6 to like 20. And then whatever's thrown at me, people send me, I really need like the T12, the rent roll. And if they have a CoStar and OM, that's great. If not, I can work with the T12 rent roll. And then I'll glance it over, see if I like it, just to kind of match up the revenue with the price to see if there's an alignment there based on just kind of where I know things need to fall. If it's close, I'll underwrite it. And I'll probably underwrite of those, 6 to 20, maybe a third of those will actually get underwritten in a week. And then from there, it's about finding like the one or two that are maybe have potential. And then those one or two, I'll go deeper on, do the rent comparables, go into the, more the minutia, the CapEx, and just go a little bit deeper dive. And then when I get one that I think is closest or close enough, I'll write an offer. If there's an auction process, I don't typically write an offer unless I'm very certain that I can get close, just because I know it's going to get bid up pretty high. If there's no auction process, then I'll just write an offer at the price I can come in at. And sometimes it works, sometimes it's not. Right now, I'm writing a lot of offers that are just not doing anything because we're too far apart. That's just this current environment. But, back in February, even last year, it was, all right, we got to go through this full process, the auction process, best and final. I'm flying to the property to make sure that, I have eyes on it before we go in hard and try to, win these deals. So it fluctuates a little bit, but that's kind of the funnel.
Yep.
It's just about getting a lot of things in front of you that fit your box. And yep. I also I think a mistake people make is that they go in to these brokers and they give them such a narrow spectrum of what they can get, which works for some people. But I like to go in and say, listen, I'm looking for, this range of units. So maybe it's 50. Right now it's 50 to 200. This max price, so I can't pay more than 15 million. And then, I just want a value add strategy, like whatever your strategy is. So if it's value, I'll be like some kind of value add. Yep. So I hit them with 3 things that kind of gives them the parameter that they need, and then that will give me more deals, and then I can kind of understand the fluctuation.
Got it. Well, let's back up. So you obviously we've done deals together in a couple of different markets. Walk us through the process of saying, what does it look like? What does a good market look like? And if it's a market you're not familiar with, what are your process to identify that MSA? What are the characteristics? What are the resources you use to try to get narrowed in on understanding what a good market is for your type of property?
Yeah, so everybody's got their own opinion on this, and it really comes down to, for at least for me, like my experience, it's like, all right, what markets do we kind of want to focus on, and why? And part of it is, there's some people that say just focus on just the market and that's it, but find your top 5 markets that you like, and then go after them. But the thing that they're forgetting is that there's got to still be volume in the market. So like, for example, some people may say their top 5 list, and one of them is Reno, one of them is like Lake Tahoe, One of them is, I don't know, Vegas or something. And those could be great markets, but if there's nothing trading there, or there's not a lot of deals trading there, you're not going to be able to scale that well. So it's a combination of understanding that there's things trading in the market, and then actually looking at the market metrics and making sure you're good with what's happening there. And so the way that I do that, right away, I got to have minimum of 350,000 people in the MSA. So the reason for that is because if you go in and it's too small of a market, it's like tertiary, you don't have enough resources after you get into the deal. If, for example, like property manager isn't good and you want to find a new one, well, there's maybe only 5 in the market that actually you can pick from. And that puts you at a disadvantage after you get into it. So minimum of 350,000 people in the MSA is one metric I for sure look at. I like to look at the population. Since year 2000, you can Google, your market population, and it'll show like a graph. And I like to see an upward trend on that. So that's just more fuel for that market. And then you can use a site called citydata.com and type in the market that you're looking at. It'll give you a ton of good metrics. You want to see crime going downward. You want to see medium home income going upwards. You want to see, just look at the overall market metrics and make a decision. Look at job growth. You can Google jobs. What kind of employers are moving into the area, and see what's happening there. And then also rent growth. And you can find all this data online. And so you kind of look at the combination of the whole, and if there's, if you're declining in population, your rent growth is kind of like not moving, job growth has been like whatever. I mean, then the only way you can really make money in those markets, in my opinion, is you have to buy really well. But you're at a bit of a disadvantage because you have more of a headwind than a tailwind. But if you get all those other metrics and they're looking really good or decent, then you're going to have a good tailwind behind you. Makes it easier to make money and make your investors money. So you want to look for that kind of stuff.
Got it. Say the name of the website again you used. Is it City Data?
Citydata.com, yeah.
Citydata.com.
Yeah.
Okay, so you've evaluated a market. You've gone through crime, population, volume, market, rent, density. What's next? And how do you identify the best brokers, and what does that conversation look like to start getting deal flow and building a relationship with them?
Yeah, so the way I do it actually is I have I have all the main brokerages on like a spreadsheet, and I actually will go to each broker's website, because the way things are going right now, the brokers that find deals, they take their deals and they put them on their website, and then they many times aren't marketing them anywhere else. So like you can go on like LoopNet, you can go on Crexy or some of these other sites, but realistically, most of the deals exist on the actual websites of the brokerages. So you want to check each brokerage website and see which one has the most deals. And then you're going to know, and then call those people. And, they're sometimes hard to reach, but you try, shoot them an email. And when you're talking to them, I mean, the biggest thing is you got to kind of know what you're talking about. So you got to know the language of real estate, which I know Michael teaches. And just so you can have a good conversation with them. They don't think you're a newbie, because there's a lot of tire kickers out there and you want to set yourself apart. And so I think the first step is just identifying where the volume is in the market, which brokers are doing a lot of volume. You could check all the websites, see where you're seeing a lot of deals from the same brokers, and reach out to those people and just tell them what you're looking for.
Okay. How does someone who's newer to this business or hasn't done a deal in that market, how do they set themselves apart as a serious buyer who has a high likelihood of closing? What's good language or strategies that you'd recommend someone new in the business trying to set themselves apart if they don't have a longer acquisitions history? Yeah,
I'd say, you can go in and be like, hey, you chat with the broker and just say, hey, listen, you can be upfront and be like, listen, I've been doing this for, this amount of time, but I'm aligned with some people that are pretty experienced. I think don't underestimate the power of finding somebody that's experienced and being able to leverage their experience as long as they're okay with it. They have to give you the go-ahead that, hey, listen, I need somebody that I can align myself with that gives me more credibility when I'm talking to brokers. And then, I think that's powerful, because if you don't have the experience, you want to have at least someone next to you that signs off, that says, yeah, you know what, you can go and shop on my behalf, or you can go and talk to brokers on my behalf. And then I would say mention, so like, listen, I haven't been doing this that long, but I'm aligned with these guys over here that have been, and we're very confident we can close a deal. They've done X, Y, Z in the past. And, you're almost acting as kind of like a spokesperson in a way. And that'll just allow them, oh, okay, so you're working with these guys. There's a lot of they know that there's a lot of spider webs out there that happen. It's just, making sure that person is okay with you doing it.
Good, great tips. Okay, so we're in a market, you got deal flow. Let's walk through the specifics of your underwriting, specifically rent potential analytics, right? Every broker I've ever talked to in every city on every deal tells me, hey, guess what? Rents are below market. Every broker, that's kind of like just their standard line, is rents are below market. How do you validate what they're saying? What is your underwriting guidelines specifically, just starting around rent?
Yeah, so what you do is you look, they're all saying the same thing, right? Like, yeah, it's below market, like you mentioned. Well, you want to get like real-time data. It's actually easier than you think to get that. I don't trust CoStar reports. I don't trust any of the data that's out there, to be honest, as far as rents go, because they fluctuate so much. So the best way to do it is to find out, all right, what are the actual rents? Look at the rent roll of the property that you get. What rents are they actually getting? And then you can plug them in like on a spreadsheet. And you can take that, divide it by the square footage of the actual unit for that rent, and you get kind of like a price per square foot. It's like, maybe 80 cents or 90 cents. And then look in the OM, and you find the other properties are using as rent comparables in the OM. Disregard the numbers that are in there. Put those on the same spreadsheet in different lines. Take, like, let's say the top three that you think are the closest to that property that you're looking to buy. And you can look at, amenities, you can look at the distance, you can look at the vintage of the property, and just try to find the closest three. And it's even better if you can find one of those that's been renovated, like an interior renovation or something like that that's done. Because that's where you're going to try to take the rents, right? So if you have a property that's close, that has, renovated units and similar vintage, that's great, because if your property is a classic unit property, you want to take it to a nicer look, you have kind of a guide in that. You call that property directly, call the site. Hey, I'm looking to move in. I'm not sure if I'm moving in by myself or with my friend. Could you give me some pricing for 1s and 2 bedrooms? And then just get the actual pricing for those apartments, and ask them, like, are these like renovated? Like, what's going on with them? What do they come with? What utilities they come with? And then take note of all those. It won't take you that long. It'll maybe take you 5, maybe 10 minutes to get all that data. Now you have real-time data for the market, and kind of where things are hitting. And then you do that over like 3 properties, 4, maybe 5, and you'll get a good understanding of where you might be able to take the rents. And that's how you really get real data in time. And based on, then you have a better understanding of where you might be able to take them versus what the broker's telling you. Their objective is to just sell the deal. So,
right.
Maybe they're lower than what the guy said. Maybe they're higher. Either way, now you have the real data.
Got it. Cool. So let's talk about expense, the expense component of the P&L. So you'll get an OM, you'll maybe get a T3, a T12, sometimes it's actual, sometimes it's pro forma. Walk us through that. What works, what's helpful? I think one of the questions here was, do you want to base your offer off a T12 or T3 or versus a pro forma? How does even the property management work into that expense forecast?
Yeah, so you always want to underwrite using a T12. The way I do it is, if you're using the SDA, I add a tab into the SDA that just says T12 on it, and I actually copy in Excel, paste it into the SDA, because then it's right there for you. You can easily refer back to it versus having to reopen it every time. And what you want to do is you want to go on the income side using a T3. So if that doesn't exist, you want to create it. It's very simple. You go into so everything all the way down to other income. You take the last 3 months in the T12, add it together and divide by 3. And then in the next column, multiply that by 12 and just carry it all the way down through the income. Now, the reason for that is because if, let's say, your occupancy was at 70% at the beginning of the year, and now it's at 92%, that you can't take the average of all of that, because it's really in real time what's really happening is really at 92% for the last 3 months. That's more realistic than an average from when it was 70 all the way up to 92. And that's only applicable on the income. The expenses, you want to just take the average of the T12. So T12 works for that. So you're taking the T3 income, the T12 expenses, and that's your most realistic number that you're going to use in your SDA.
Yep.
And then you want to create the buckets that are in alignment with your SDA. So I'll go through and I'll color code all the expenses and the income to match the buckets on that T12. So let's say, often what you'll find is like in general and admin expenses, they'll just include the management fee inside of all that. So you want to pull the management fee out, that's separate in your SDA, and the rest is all general admin expenses. And create your own buckets for the SDA, color coded inside the T12 so you can refer back to it easily. And that's going to give you the most transparency and help you understand the deal a lot better. And one strategy that you can use to really help I'm seeing a lot of people haven't done water savings on their assets. It's a really easy way to bring down your water bill by up to like 40%. If you allot some of your CapEx money to switching all the toilets, and there's companies that do that, and you can hire them, they'll just go through and do it all in a couple of weeks. You can lower that water bill by up to 40% if they haven't done that already. And that's an easy way to add value right away. And so you can look for that. And if the water bill is like crazy, I could save 40% on that. Let's do it. Spend 100 grand, save 40% of water bill. That's how I do it.
Cool. That's cool. When you're obviously, the acquisitions, you're underwriting what the property's performing at, what it could perform at. How do you model disposition value? Because that's sort of the big, that's the big exit price that helps put valuations into your returns for your investors. How do you what's your exit valuation strategy? Yeah,
so this is a bit, there's not like the one right way to do it, but it's more like a feeling based on the information and data you collect in each market. So like if I'm in a worse, like the main thing you got to look at is the location and the vintage of the property are really the main factors that go on. Plus you want to check sales comps. So I try to get sales comps right away, and often the broker will be able to provide you with sales comps if you ask, and cap rates that those other deals have traded at, to give you a bit of a guide as to where to kind of look. And then you want to look at like an 80s vintage property is going to trade at a lower cap rate than a 70s vintage. It's just part of it. And then if it's a better location, it's going to trade lower than a worse location. Yep. The worse the location, the older the vintage, the higher the exit cap rate needs to be. And then it's kind of like a guess at that point is like, where can I be conservative? If things are constantly trading at my vintage and my location, and I feel good that they've been trading in low 5s, then I maybe want to make my exit cap at like 6% or 6.25%, So it's, and then you play with it based on where things are falling. You want to just create enough insulation. The whole key of underwriting is, you want to provide enough insulation, but not too much where you're shooting yourselves in the foot and you can't do a deal. So that's kind of how I go about that.
Got it. Okay. Talk to me about how you evaluate property managers, because obviously everyone in this deal is transactional. Our attorney is transactional, our accountant is transactional, the broker is, but the property manager is your long-term partner. What are some things that you use to evaluate who's the right fit for the property manager to execute our plan to make our property meet our expectations?
Yeah, so you want to find a property manager that one thing that you're gonna run into is if you find a property management company that they have let's say 500 units, and you're trying to buy a 200 unit complex, and they're like, I would love to do that, yeah, because they're gonna double or half up their size of their company overnight. You want to avoid that. You want to take on a property manager that has enough volume that they can absorb your property, no problem. Now, if you're buying a 50 unit and they have 500 units, that might be okay. Probably still a little bit too small, but you got to think these property management companies, you're buying into their economies of scale for the most part, and so you want to align whatever property type you're buying. What is the main type of property these people manage, and you want those to be very similar. So if they manage mostly 50 and 100 units, and you're buying a 50 unit, that might be a good fit. But if you're buying a 200 unit and they manage 50, 100 units, it's not a good fit. So that's kind of like step one. The way you kind of source really good way to source management companies, kind of behind the scenes. Well, you can of course ask brokers who they think is doing the best job in town. They'll usually know. They'll give you a few ideas. But I go on apartments.com and I look at the properties that are similar to my property, and I see who's managing it. And when you see the same names pop up over and over again, you're like, oh, let me reach out to them. And then the final thing is when you're trying to evaluate a property management company, because you have an idea now of who's doing what. Now you got to get references, but you don't just want to ask them for references because they're going to give you the best people. So go on their website and pick 5 to 7 properties that they are managing at random that maybe are similar to your asset and similar location. Ask for those references. Be like, hey, I want references, but I want to pick them off your website at random.
Got it.
And then that way you're not going to get a biased reference. So I think that's how we found our property management company in Nashville. Is I had a few on the table, and I was like, listen, I want to call some randoms, and I did, and all the randoms were raving about it, and we're having a good experience now. So I think that's a good way to do it.
We had a question that just popped up here. Will you work with a PM company that also owns multifamily in that market? Do you have any concern about property managers who are also competing against you?
So that's a great question, actually. The PM company we're using now, they actually do, and it can be a conflict of interest. So you have to address it properly. But that's honestly you're going to find that a lot of property management companies, their strategy is to own properties and then manage them also. So I would just address it with the president of the company and be like, hey, how do we avoid this? Make sure I don't want you guys to get precedence over our property if we're across the street or whatever, and just listen to their answer. And if you're okay with it, you feel comfortable with it. We're having a fine experience with our company. They own 6,000 units. They manage, I think, 25,000, and there's been no issue so far.
That's good. Cool. So if anyone, we still have some people that are watching. If you have questions, put them in the chat box. I got a couple more things I wanted to run through with Garrett, and then we'll answer any more questions that you have about the entire acquisitions process. So Garrett, the other thing that you do is for Michael Blanc's organization is you sit on their deal desk. Can you describe what that deal desk is and what are some common underwriting mistakes that you find as people bring deals to you to evaluate?
So there's the deal desk is basically a way that if you bring a deal, we can partner with you. So the people will bring deals in that for review, and if we like it and it fits our parameters and our timing, We'll actually partner with the person. We just did that one in August, was actually a student. And so that's a pretty unique opportunity, and it's pretty cool. But the thing is, your underwriting has to come in, I think, pretty tight. And if not, it's fine. We'll go through it and we'll fix it. But some of the common mistakes that I see over and over again are people don't. First, number one, they don't calculate their taxes. So when you buy a property, taxes go up most of the time. If you're buying it at a higher price than what it was before, it's going to affect your taxes. And it's a big number often. And the best way to calculate the taxes is if you find, if you want to do like a quick run on it before getting really granular, figure out what percentage of the purchase price they are allocating towards taxes. So like, for example, if it's a $10 million property, often they take 40% of commercial deals. So I will multiply the 10 million times 0.4. That's now your new assessed value. And then you want to find the millage rate. It's called the millage rate. Sometimes it's on the broker's OM. Otherwise you can Google it, or you can call in and figure out what that is. And then you multiply it by that percentage. So often it's like 3% around that. It's like a weird number. And so you multiply that assessed value times the millage. And that's going to give you a more accurate depiction of what the taxes should be. Every county, every state is different. So, this may not be just, sometimes they're assessed in different times so that the taxes aren't going to hit for a couple years. So there's a lot of variables to it, but generally that's how I start. Mm-hmm. And then I will cross-check the taxes by calling like a tax accountant or a tax attorney that deals with property tax to get a more accurate depiction of what that is actually going to look like. But I'm generally in that right range if I go about calculating it that way. So that's one thing. The other thing is they don't understand their debt strategy. So right now, especially, it's really volatile in the market, and there's only certain things you can do. Like right now, your highest chance of closing a deal is going to be with agency debt if you're going down recourse. And, you can't buy a deal that's less than 90% occupied if you're going to go that route. So, if you come to the deal desk and you have, a deal that's 80% occupied and you're trying to underwrite it to agency debt, it's not going to work. So you got to understand a little bit, the debt is so important in your deal and your strategy around that debt. When you're going to exit, what is your prepayment penalty going to be if you go with this type of debt? And people miss that stuff a lot, and I get it. I mean, it can be very complicated and challenging, but your mortgage broker should be able to give you the ins and outs of that. And if you're not working with a mortgage broker, I'd recommend doing so. And that way you understand, all right, what can I really accomplish on the debt side? What's not in there. So people miss that a lot. Third thing is they're not doing their rent comparable research. And I just talked about how to do that earlier, but that's pretty important when you come to the deals. If you're trying to simulate rent bumps in, how do you understand what those rent bumps are? Well, it's doing what I just said earlier, and people don't do that enough. And so then the last part is underestimating the amount of CapEx it's going to take to actually get things where they need to be. I think people come with like just the minimum amount of CapEx, and that's not really conducive to a realistic project. When you get into a deal, there's always more stuff that pops up that you didn't allot for, and it does. Having enough money to actually execute your plan, I think, is super important. So I try to come in as if my deal's looking really good, I just add more CapEx so that it doesn't look as good, because I want more money, as much money as possible going into these deals. The deal we're doing right now in Huntsville, I'm extremely happy because we allotted for, I think it was like over $3 million for that deal. And it's really helpful now because there's all these things that popped up, like pool furniture is $20,000. Okay, I forgot about that. Like stuff like that. Yeah. So it's just stuff adds up. I mean, your expenses are higher on these properties than you think, and your CapEx is higher than you think. And so it's good to have more money for that. But I think people miss that quite a bit.
That's fantastic. That's awesome, Garrett. Quick question came up. Obviously, it says, how are you accounting for the year P&I reserves so that the SDA models it correctly? So that kind of gets into a little bit of the question of what are you doing today that you weren't doing 3 or 4 months ago, right? How are you modeling things differently? What are different questions you're asking? What's the best way to operate efficiently?
So I actually set up an SDA, like a template for what's happening in the market. Every time something changes or fluctuates, because it's much faster to go through deals. So right now I have a Freddie SDA template because we're underwriting to Freddie floating debt. So it's set up that way. So part of that is it automatically populates that reserve into the acquisitions tab. So you want to add a line item for the acquisitions in the acquisitions where it says lender reserves, and you can actually have it auto-populate from the P&L tab your principal and interest payment. So find out where that is going to be, have it populate automatically in the acquisitions tab. And then I actually have it also automatically giving it back to investors in year 3. So you go into the P&L and I highlight it, make sure you know where it's going. But where it says investors, like where it has their split. So if it's, let's say 80-20, and you have 80% of the cash flow going back to investors, I'll actually add that back in year 3 so that my whole deal isn't getting smoked. So I'm not going to have those sit in the escrow reserve for the entire hold.
Yep.
And 2 years it might be fine, but 3 years I think is just very conservative. And so I'll have that money, that big reserve that's going in for 12 months, enter back into the investor's pocket in year 3.
Yep. And the context for that question was these are loans that are going to be offered from Fannie and Freddie, we're now requesting that at closing you deposit additional escrows equal to 1 year of the principal and interest, even if your loan is an interest-only loan for several years, right? So this is a way for the lenders to have a little bit more protection to make sure that their loan is secure as they spin that loan out to their investors.
Yep.
Do you think that's going to continue? Do you think this is a permanent thing? What do you look in your crystal ball? What do you think is going to happen in the next 3 to 6 months?
I think it's not going away for a while.
Yep.
The lenders are, they want to be protected, and they don't know when there's uncertainty in the market. They have to find ways to hedge. And right now the talk in the beginning was, oh, we're going to get hurt in April and May, and those kind of worked out. Everybody's, oh, it wasn't that bad. There's also a lot of stimulus money out there. So now the thinking is that things are being propped up from the unemployment and the stimulus and all that stuff. Once that runs out or they stop doing it, everybody's going to get hit pretty hard because there's still a ton of unemployment. So, these lenders are very, they're constantly talking, and I'm constantly staying in touch with my brokers and different lenders to understand kind of where their head's at. But I don't see the reserves lifting that quickly. It's going to be around for a minute until things stabilize. And I think a lot of the damage is hit, but we haven't seen the effects yet. And so it's going to be interesting, to see kind of where this ends up going. But, luckily our interest rates are still low, but this reserve it might stick around for a while. So the way to kind of combat that is, and I'll say one thing, Freddie actually over $6 million, they've lowered it to 9 or 6 months. So that's been good. So that's maybe a type of loan you might want to look at as a Freddie floating rate. But the other way to avoid that is to take on a recourse loan or to assume someone else's loan right now. So those are kind of, if you want to avoid that additional cash that you have to raise.
What are you hearing from the non-agency side? So like the bridge lenders out there, how have their terms changed? Are there still a propensity to loan to lend?
No, so bridge lenders right now are pretty much dried up for the most part. Your best chance of closing is going to be with an agency. I mean, yesterday I had someone tell me that there are some bridge lenders that exist right now and they're still going. But the challenge with that is that if you do go into that situation, you're paying a bunch of money to enter into a loan where they can potentially retrade, and they're the most finicky loans right now. I love bridge debt. in the right context, when it's solid, I mean, you can do a lot. You can get a lot of CapEx out of it. They're flexible. You can get out of them. I think it's great, but when the programs are kind of rocky, it's not worth it. I don't think it's worth it to go into a deal with an uncertain situation on the debt side, and then you create all these other problems as you get into it, and you just paid them $50,000 to get into it. So I would be very careful and cautious around that. The only bridge programs that you can maybe take advantage of right now that I've heard of are local banks. That are doing bridge programs. But the downside with those is that you're not going to get much IO. Their interest rates are slightly higher right now, and their amortization is low. It's usually like 20 versus 30. Yep. So it's not going to be a long-term situation at all. It's going to be something you might have for a couple of years. But it'll allow you to do deals that are less than 90% occupied.
Awesome.
If you're comfortable. But then also you got to think, if your deal is less than 90% occupied, you have more risk of losing the deal if it doesn't go right. So, and you're now in recourse debt, so you got to be very careful.
Should talk to us. Probably last thing here, putting up hard earnest money. What are your thoughts on that? What should people consider?
Right now, don't do it.
Okay.
4 months ago, you had to do it. I mean, we did it on our deal that we closed in December, and that's the only reason we won the deal is because we put up, I think it was $85K hard or something, and that's what put us over the edge. And it's really about your risk tolerance. If you're okay, you got to think, am I okay with losing this money? At the time, I think we would have, all the partners would have each lost whatever 17K or something. I was like, I'm okay with taking that risk. It's worth it to try to land a deal that I wouldn't normally have. And if I'm going to lose it versus that, I'd say, okay, some people are totally against it. I've been against it forever, but you got to come to play ball at a certain point. And that's what was existing before. Now, it's so uncertain with that you'll even close the deal. Right. And I would be negotiating in not just no hard money, but financing contingencies and everything. Before, I'm okay with it, depending on the amount, of course. I don't want to go 800K hard into something that's insane. But now I'd say no, avoid it.
Awesome. Garrett, this has been awesome. Thank you so much for taking time to go through your tips and tricks on the acquisition side. If people want to follow up with you or want to get something in front of you on the deal desk, what's the best way to do that?
Yeah, you can email me, Garrett at nighthawkequity.com. So GARRETT at Nighthawk with an N, NIGHT, HAWK, equity.com. You can even, if you want to shoot me a text, I'm happy to do that. 630-709-8636. We can set up a call or whatever if you have any questions.
That's awesome. Cool. Thanks, Garrett. Appreciate it.
Thanks a lot, Drew.